Everyone thinks the hard part is making money in the markets. They are wrong. Making money is actually the easy part. The mathematics of compounding, the logic of value investing, the basic principle of buying low and selling high, these ideas are not complicated. You could explain them to a reasonably intelligent 12-year-old in under 30 minutes. The rules are simple. The playbook is public. The information is free. Warren Buffett has been publishing his letters for decades. The entire intellectual framework for building wealth through markets has been available to anyone with a library card since before most of us were born. So why aren't more people wealthy? Because the hard part, the genuinely, brutally, almost impossibly hard part, is not making money. The hard part is not losing it. The hard part is sitting still when every neuron in your body is screaming at you to act. The hard part is watching everyone around you apparently getting rich on something you passed on and not cracking. The hard part is resisting the buy signal that comes packaged in social proof, media frenzy, and the intoxicating smell of easy gains. The hard part is surviving the herd. Most people have the problem backwards. They spend their entire investing lives searching for the next big trade. They want to find the rocket. They want to identify the asset that will 10 times their money. They read books about technical analysis. They watch charts. They subscribe to newsletters. They join Discord groups and Telegram channels filled with strangers who are equally clueless but far more confident. They are chasing an answer to the wrong question. The right question is not, what should I buy? The right question is, what should I never buy? And when should I never buy it? And the answer to that question, refined down to its mathematical core, is devastatingly simple. Never buy what everyone is screaming about. Never buy at the peak of collective excitement. Never confuse the volume of noise with the validity of a thesis. The moment a trade becomes consensus, it stops being an opportunity and starts being a trap. The moment your taxi driver, your coworker, your uncle at Thanksgiving, and 3 different Instagram influencers are all telling you about the same asset, that asset has already priced in every optimist. There is no one left to buy. There is only the exit. But understanding that intellectually and actually living it in real time are 2 entirely different cognitive challenges. And to understand why, you need to stop thinking about markets as economic systems and start thinking about them as physical ones. Think about a pendulum. A perfect, frictionless pendulum in a vacuum swings from one extreme to the other with mathematical precision. At each extreme, it pauses for one impossible instant before swinging back. The pendulum never stays at the top. Gravity does not negotiate. It does not care how many people believe the pendulum should stay at the top. It does not adjust its timeline based on social media sentiment. It obeys laws that were written into the fabric of the universe long before human beings invented the concept of a price chart. Markets are pendulums. Every asset that swings violently toward euphoria must, by the physics of financial gravity, swing back toward despair. Not because of some mystical force, not because the universe is punishing greed, but because the mechanism that drives prices up, the flood of new money chasing momentum, is self-limiting. Every buyer becomes a potential seller. Every new entrant at a higher price creates downward pressure the moment they need liquidity. The higher the price goes above intrinsic value, the more energy is stored in the system and the more violent the inevitable correction. This is not speculation. This is not pessimism. This is thermodynamics applied to human behavior. The problem is that most retail investors, most ordinary people who are trying to build a better financial life, enter the market at precisely the worst moment. They do not enter during the long, boring accumulation phase, when prices are flat and no one is paying attention. They do not buy when the asset is unloved, undervalued, and covered in bad press. They buy when the asset is everywhere. They buy when the narrative has already been written, polished, packaged, and sold. They buy at the peak of the pendulum's swing, when the only direction left is down, and they wonder why they always seem to lose. This is not bad luck. This is physics. There is a concept in rocketry called escape velocity. If you want to leave Earth's gravitational field, you cannot simply point a rocket upward and apply gentle, consistent thrust. It will not work. Gravity will win. You need to reach a specific velocity, approximately 11.2 kilometers per second, before Earth's gravity no longer has enough pull to drag you back. Below that threshold, it does not matter how much fuel you burn or how long you maintain thrust. You are going to come back down. The same principle applies to breaking free from the gravitational pull of herd psychology. A little discipline is not enough. Reading one book about value investing is not enough. Telling yourself you will be different next time is not enough. You need to reach escape velocity, a fundamental, deeply internalized understanding of how the system works and who it is designed to benefit, before the noise of the herd loses its power over you. And the system is very specifically designed to benefit someone other than you. Let us be precise about this. Let us strip away the comfortable mythology that markets are neutral mechanisms for price discovery, where every participant has an equal chance of success based on the quality of their research and the sharpness of their analysis. That mythology is a sales pitch. It is the story that the people at the top of the system tell to the people at the bottom to keep them engaged, keep them trading, keep them paying commissions and spreads and management fees. The reality is structural. The reality is that markets have participants who operate on fundamentally different timescales, with fundamentally different information, and with fundamentally different costs. And the people at the bottom of this structure, the retail investors, the small traders, the weekend warriors with brokerage accounts and big dreams, are not competing in a fair game. They are paying a systematic tax for the privilege of participating. Consider the mechanics. A market maker, the professional entity that sits between buyers and sellers and provides liquidity to the market, makes money on every single transaction, regardless of the direction of the price. Every time you buy, they collect a spread. Every time you sell, they collect a spread. They are not betting on direction. They are extracting a toll. Their business model depends on volume and volatility, not on price appreciation. They need you to trade. They need you to be anxious, excited, reactive. A calm, patient investor who holds for years and barely checks their portfolio is their worst nightmare. A panicking retail trader who checks their portfolio every 6 minutes and executes 17 trades in a single session is their ideal customer. Now layer in the institutional advantage. Hedge funds and large asset managers have access to data, research, and technology that would have seemed like science fiction 20 years ago. They have teams of mathematicians analyzing order flow. They have relationships with corporate management. They have early access to research that moves markets before it becomes public. They operate on timescales measured in microseconds. Their algorithmic systems can detect the signature of retail buying patterns, the frantic, momentum-chasing, FOMO-driven buying that happens when an asset goes viral, and position themselves on the other side before the majority of retail orders even execute. This is the entry penalty. This is the Vimes-Boot theory applied to financial markets. The Vimes-Boot theory, for those unfamiliar, comes from Terry Pratchett's writing. The insight is this: a man who can afford to spend $50 on boots buys a pair that lasts 10 years. A man who can only afford $10 buys a pair that lasts 1 year. After 10 years, the wealthy man has spent $50 on boots. The poor man has spent $100. The poor man pays more, gets less, and remains poor partly because the cost of poverty itself is so high. The system is more expensive at the bottom. In markets, this dynamic is brutally precise. The small investor cannot access institutional pricing on trades. They pay wider spreads. They often cannot access the investment structures, private equity, hedge funds, certain bond markets, that generate the most reliable risk-adjusted returns. They are forced to use products designed for retail consumption, which are, almost by definition, higher cost and lower quality versions of what sophisticated institutions use. They cannot diversify geographically or across asset classes with the same efficiency. They are more vulnerable to single-event catastrophe because they have less capital to absorb losses. But here is where the entry penalty becomes truly insidious. The small investor is also more emotionally vulnerable to the very signals that guarantee poor performance. When an asset is cheap and unloved, the small investor has no social proof. No one is talking about it. Their friends are not excited about it. There is no community of fellow believers making them feel smart and validated for holding it. The silence is psychologically uncomfortable. The lack of social reinforcement creates doubt. The small investor sells or never buys. When the same asset is expensive and hyped, the social environment is completely different. Everyone is talking about it. News articles validate the thesis. Social media is full of people celebrating their gains. The community of believers is large, loud, and intoxicating. The small investor feels smart for being part of it. They buy at the top. They experience the crash. They sell at the bottom, locking in the loss. This is not stupidity. This is neuroscience. The human brain did not evolve for financial markets. It evolved for the African savanna roughly 200,000 years ago. On the savanna, social conformity was not a cognitive bias. It was a survival strategy. If every member of your tribe was running in the same direction, the correct move, the move that kept you alive, was to run in the same direction. The animal that paused to independently evaluate the evidence while the herd stampeded got eaten. Social proof was literally life and death. That ancient programming is still running. It is running right now inside every person who has ever felt the pull of a trending asset. The dopaminergic system, the brain's reward circuitry, is highly responsive to social validation. When everyone around you is buying something and talking excitedly about it, your brain releases dopamine. Not because the asset is good, not because the fundamentals justify the price, but because you are in alignment with the group. And group alignment historically meant survival. The fear system operates symmetrically. When markets are crashing and everyone around you is in a state of visible panic, your amygdala activates. Cortisol floods your system. Your prefrontal cortex, the seat of rational, long-term thinking, goes partially offline. Studies have documented that acute financial stress reduces measurable cognitive function by the equivalent of losing approximately 13 IQ points. You become less intelligent less capable of abstract reasoning, less able to evaluate probability and expected value, at precisely the moment when clear thinking matters most. This is the biological trap. The market events that require the most sophisticated, cool-headed analysis produce the exact neurological conditions that make sophisticated, cool-headed analysis nearly impossible for the average person. The system is almost elegantly cruel in its design. And then there is the dopamine trap on the other side of the cycle. During periods of rapid price appreciation, the retail investor who is riding a winning position experiences a neurochemical cocktail that is functionally similar to addiction. Each new high produces a small dopamine hit. The anticipation of the next high produces another. The social reinforcement of being right, of being seen as someone who identified a winning trade, amplifies the effect. The brain begins to associate the market with reward. It begins to develop tolerance, needing bigger moves, bigger positions, more extreme scenarios to produce the same feeling. This is why bubbles are so psychologically potent. They are not just financial events, they are neurological ones. The people caught in a bubble are not simply making analytical errors. They are, in a very real physiological sense, high. Their decision-making is impaired by the same mechanisms that impair the decision-making of anyone who is addicted to a substance that hijacks the dopamine system. The difference is that society frames gambling on hyped assets as savvy investing rather than as the compulsive behavior it frequently is. The market makers understand this. The professional operators who profit from retail participation understand this deeply and use it systematically. The construction of a modern financial hype cycle is not accidental. It is engineered. It follows a reproducible playbook that has been running in various forms since the tulip mania of the 17th century. Through the railroad bubbles, the dot-com explosion, the housing crisis, the cryptocurrency booms and busts, the meme stock frenzy, and every other episode of collective financial madness that fills the history books. The playbook begins with accumulation. A market maker or large institutional operator identifies an undervalued or highly controllable asset. They accumulate a large position quietly over an extended period at low prices. Volume is kept intentionally low. News coverage is minimal or negative. The asset is boring. Retail investors ignore it. This is by design. The playbook continues with a narrative. A compelling story is attached to the asset. It does not need to be true. It needs to be emotionally resonant, easy to understand, and impossible to definitively disprove in the short term. The story explains why this particular asset is different, why the old rules do not apply, why this time is not like all the previous times. The narrative spreads through media, first through niche financial publications, then through mainstream press, then through social platforms, then through conversations at dinner tables and in break rooms. Each stage of the spread introduces a new wave of buyers at progressively higher prices. This is where the psychological leverage of social proof does the heavy lifting. The retail investor does not need to understand the underlying asset. They do not need to perform due diligence. They just need to notice that everyone around them is getting excited about it. The social signal is sufficient. The amygdala reads excitement in the environment as a positive indicator. The dopamine system begins priming for reward. The cognitive evaluation process gets bypassed. Near the peak, the media coverage reaches a crescendo. Everyone is talking about it. Financial news channels run segments. Social media is saturated with success stories. People who bought early and who are still holding, still benefiting from rising prices, become vocal evangelists. Their certainty is not analytical, it is emotional. They have been right so far. Their identity is now entangled with the asset. They cannot consider the possibility that they are wrong without threatening their sense of self. They dismiss skeptics as ignorant, as too scared to see the obvious opportunity. The echo chamber seals itself. This is the moment the professionals sell. Not all at once. Institutional selling at scale moves markets. A sudden, visible reversal would trigger panic before the professionals have exited their full position. So the selling is gradual, managed, disguised within the noise of continued price fluctuation. Some days, the price still goes up. Some days it goes down a little. The retail investor, who is now watching the asset obsessively and interpreting every dip as a buying opportunity, because every previous dip during the uptrend was a buying opportunity, continues to hold or even adds to their position. Then comes distribution. The professionals have sold. The institutional buyers who drove the narrative have exited or are exiting. The only buyers remaining are retail investors, and the pool of new retail buyers willing to enter at current prices is shrinking. The narrative begins to crack. A negative news event, which would have been ignored or dismissed as noise during the uptrend, suddenly registers. Price drops sharply. The retail investors who bought near the peak watch their unrealized gains evaporate. And now the biological trap closes completely. The cortisol is flowing. The amygdala is activated. Rational thought is impaired. The investor faces a stark choice. Sell now and crystallize the loss, or hold and believe the asset will recover. The very brain chemistry that drove them to buy at the top is now paralyzing them at the bottom. They hold. Price continues to fall. They hold through despair. Eventually, when the pain becomes unbearable, when the asset is back near where it started, or lower, when their life savings or their speculative capital has been largely destroyed, they sell. They lock in the maximum possible loss. They exit at the exact bottom, just as the professionals who engineered the entire cycle are beginning to accumulate again. The cycle resets. The playbook is ready for its next iteration. Understanding this structure intellectually is necessary, but it is not sufficient, because the next time the cycle runs, and it will run because human neurological hardware has not been updated since the savannah and probably will not be, the pull of social proof will feel just as powerful. The dopamine will flow just as freely. The cortisol will be just as disabling. Knowledge alone does not grant immunity. You need a system that operates above the level of your emotional responses. You need to have made your decisions before the emotional siege begins. This is what the most effective long-term investors actually do. They do not succeed because they are emotionally invulnerable. They succeed because they have built decision-making frameworks that remove emotion from the critical junctures. The points where emotional pressure is highest and cognitive reliability is lowest. Buffett does not decide whether to sell his positions when markets are crashing and his portfolio is down 30%. He decided years earlier, before the crash, before the cortisol, before the social pressure to panic. His rules are not responsive to market conditions because he wrote them when he was calm. But before you can build that system, you need to recover the cognitive capacity to build it. This requires a period that some traders describe as a kind of radical austerity. Not financial austerity necessarily, though that may be part of it, but an informational and psychological austerity. A deliberate, temporary withdrawal from the noise. A complete disconnection from financial media, from the social channels that broadcast market sentiment, from the conversations that keep the emotional activation of the market cycle running in the background of your consciousness 24 hours a day. Call it monk mode. It is not permanent. It is not about becoming a hermit or abandoning your engagement with markets. It is about reclaiming the neurological quiet necessary for the prefrontal cortex to function. When you remove the constant dopamine stimulus of price updates and market news and social media commentary, your baseline cortisol levels drop. Your capacity for abstract reasoning returns. You can think in years instead of minutes. You can evaluate probabilities instead of reacting to prices. During this period, the work is foundational. You build the intellectual framework that will govern your behavior before the next emotional siege arrives. You read the letters. You study the historical cycles. You internalize the mechanics of how value is created and how it is destroyed. You develop a clear, explicit, written investment policy that tells you exactly what you will buy, under what conditions, at what price ranges, and what you will do when markets do what markets always eventually do, which is behave in a way that makes you want to abandon your policy. The written policy matters more than most people realize. It matters for a biological reason. When you make a decision in a calm state and write it down, you are encoding that decision in your prefrontal cortex. When you face the same decision later, in a state of emotional activation, the written record acts as an external memory that can partially override the limbic response. It is not perfect. Nothing is. But it gives your rational mind a fighting chance against your ancient survival circuitry. The next layer is the development of what you might call a personal analytical moat. This is not about becoming an expert in everything. The people who try to understand every sector, every asset class, every emerging technology are not analytical superheroes. They are dilettantes with broad ignorance disguised as breadth. The goal is the opposite: to develop a very deep understanding of a narrow set of domains, and to have the discipline to operate only within those domains, regardless of what is happening elsewhere. The power of the analytical moat is not the knowledge itself. It is the psychological security the knowledge provides. When you deeply understand the fundamentals of an industry, when you have spent years studying it, when you understand the competitive dynamics, the regulatory environment, the capital requirements, the margin structures, the historical valuations, a hyped narrative about that industry that does not match the underlying reality is immediately obvious to you. The emperor has no clothes, and you can see it clearly because you have spent enough time in the kingdom to know what the emperor is supposed to look like. The retail investor with no moat, no deep domain expertise, no foundational framework, has only social proof to rely on. They cannot evaluate the narrative independently. They can only measure its loudness. And loud within a hyped sector that have actual competitive moats from those that are simply riding the wave of the broader trend. They can act with conviction when others are panicking, and they can sit calmly when others are euphoric. Not because they are emotionally superior, but because they have a basis for independent judgment. Independent judgment is the only real protection against herd psychology. There is no other inoculation. You cannot rely on discipline alone, because discipline, under sufficient emotional pressure, eventually breaks. You cannot rely on rules alone, because rules without understanding are fragile under stress. You need the ability to look at the situation independently and reach a conclusion that does not require the validation of the crowd. And that ability comes only from depth of knowledge, not breadth of enthusiasm. This leads directly to the social dimension of the problem, which is often the most practically challenging aspect for people who are trying to break the cycle. The herd is not abstract. The herd is your coworker who made money on the last run and wants you to feel as stupid as possible for missing it. The herd is your family member who is absolutely certain they have found the next big thing and wants you to get in with them. The herd is the group chat that was dead for 6 months and has suddenly exploded with price updates and buy recommendations. The herd is not a faceless mob in a financial history book. It is the people in your immediate social environment, and their pressure is real, personal, and psychologically potent. The effect economists sometimes call the crab bucket dynamic, the observed tendency of people at the same economic level to actively resist any individual who appears to be breaking away from the group, operates in financial behavior as powerfully as it does in socioeconomic mobility. If you are the person in your social circle who did not buy the hyped asset when everyone else did, you will be mocked or dismissed. If you are the person who sells the hyped asset at a reasonable profit while everyone else is still holding and dreaming of greater returns, you will be told you sold too early. If you are the person who quietly holds index funds and boring compounding assets while everyone around you is chasing the exciting trade of the month, you will be told you are missing out. You will be told you are too conservative. You will be told you are not taking the market seriously. This is not friendly advice. This is social pressure to maintain group behavior. It serves the herd, not you. The response to this is not defensiveness or argument. Arguing with someone in the grip of euphoric conviction is like arguing with physics. You will not win, and you will expend energy you need for other things. The response is a kind of strategic social withdrawal from the financial conversation, combined with a deliberate construction of a different intellectual community. The mentors do not need to be people you know personally. The most important mentors in the long-term intellectual development of any serious thinker are almost always people they have never met. People who are accessible only through their writing, their lectures, their documented thinking. The letters, the biographies, the interviews, the out-of-print books that most people have never heard of. These are the relationships that compound over time with zero toxicity and zero social pressure. When you spend an hour reading a letter from someone who has navigated 40 years of market cycles with consistent discipline and superior results, you are not just acquiring information. You are training your emotional responses. You are spending time inside a mental model that is calmer, longer term, and more mathematically rigorous than the mental model that your daily environment is constantly trying to install. You are incrementally rewiring the neural pathways that govern how you respond to market events. This is slow. It is not glamorous. It does not produce the immediate dopamine hit of a successful trade or a viral stock tip. But it compounds. Every book you read, every case study you absorb, every historical cycle you internalize makes you slightly more resistant to the next hype cycle. The knowledge accumulates. The emotional immunity builds. It does not build to 100%. You will always feel the pull. But it builds to the point where you can feel the pull and still make the right decision. The mathematics of this long game are unambiguous. The compounding investor who earns a consistent 8% annually on a capital base that they never decimate in a hype cycle will, over 20 to 30 years, dramatically outperform the active trader who occasionally hits big wins but repeatedly suffers the catastrophic losses that come from buying at the top of hype cycles. The math is not close. The gap is enormous. The consistent, boring, patience requires no genius approach wins not because it is optimal on any individual trade, but because it survives. Survival is the prerequisite for compounding. Compounding is the mechanism by which ordinary amounts of money become extraordinary ones. And the single greatest threat to compounding is not a bad year in the market. It is the catastrophic loss that requires years of positive returns just to return to break even. This is the assets versus liabilities reframe that everything ultimately reduces to. An asset, in the most rigorous definition, is something that generates positive returns over time, regardless of your emotional state regarding it. A liability is something that requires constant inputs and produces returns that are conditional on your ability to time it correctly, react to it correctly, and exit it at the right moment. Hyped assets, bought at the peak of a social frenzy, are almost by definition liabilities. They require you to be right about timing. They require you to be smarter than the professionals who engineered the narrative and positioned themselves to exit before you. They require you to perform at peak cognitive capacity under maximum emotional pressure. The investor who has built their portfolio around genuine assets, businesses with durable competitive advantages, diversified holdings that benefit from long-term economic growth, positions that are structured to not require active management or correct timing, is the investor who has put the mathematics of compounding on their side. Every year they hold, they collect the economic output of productive enterprises. Every year the active trader chases the next hype cycle, they play a game that is statistically designed for them to lose. The contrast between these two profiles is not a difference in intelligence. It is not even primarily a difference in information. It is a difference in the ability to sit still. It is a difference in the capacity to observe a crowded exit and walk in the opposite direction. It is the willingness to be wrong in the short term, to be mocked, to miss the apparent gains of the euphoric phase, in exchange for the survival that makes long-term compounding possible. Sitting still feels like doing nothing. It looks like doing nothing. To the people around you who are excited about the latest trade, it looks like cowardice or ignorance. But it is neither. It is the single most difficult cognitive achievement in investing. It requires more intellectual honesty than any trade recommendation. It requires more psychological strength than any bold buy decision made in the heat of social excitement. The loudest, most exciting moments in markets, the moments when everyone is screaming about something, are the moments that demand the absolute quietest response. The cage, as in any system designed to capture and hold people who do not understand its mechanics, is structurally open. The market makers cannot force you to buy at the top. The algorithm cannot compel you to panic sell at the bottom. The social proof is powerful, but it is not mandatory. You can sit out. You can observe the stampede from a distance. You can look at the screaming crowd and recognize, with the calm certainty of someone who has internalized the physics of the pendulum, that what you are watching is not an opportunity. It is a transfer of wealth from the people who arrived late to the people who arrived early. From the people who reacted to the noise to the people who engineered it. The cage is open, but walking through the opening requires you to move against the crowd, against the dopamine, against the cortisol, against the social gravity of everyone around you who is absolutely certain that this time is different. It requires you to have already made your decision before the emotional siege began. It requires the kind of intellectual courage that looks from the outside like stubborn inaction. That stubbornness is the entire game. The people who build real, durable wealth in markets are not the ones who find the best trade. They are the ones who refuse the worst ones. They are the ones who look at the loudest, most crowded, most emotionally charged opportunity in the room and say, Not yet. Not at this price. Not for these reasons. Not because everyone else is doing it. They are the ones who have decided, in advance and in writing, what they will own and what they will not, and who honor that decision when every biological impulse and every social pressure is pushing them toward the exit, or toward the top. The herd will always be there. The next hype cycle is already being engineered. The next narrative is already being written. The next asset that everyone will be screaming about is sitting in someone's accumulation portfolio right now, quiet and unloved, and priced for a patient buyer. When the screaming starts, you will know what it means. You will know who is selling. You will know what to do. The only question is whether you will have done the work before that moment arrives. Whether you will have built the framework, developed the moat, replaced the toxic social noise with the voices of people who actually know what they are talking about, and positioned yourself on the side of the mathematics rather than against it. That work starts in silence. It starts with the decision to stop chasing and start thinking. It starts right now, before the next crowd forms, before the next price chart starts going vertical, before the next wave of dopamine-laced social proof starts flooding your environment and asking you, politely but insistently, to destroy your financial future on the altar of collective excitement. The pendulum is always swinging. The question is whether you are riding it or watching it.